return on capital employed is equals to PBIT upon capital employed multiplied by 100. What is PBIT? Profit before interest and tax upon capital employed. Now you will have a question, why it is profit before interest and tax and not PBAT, that is profit after taxes. We will understand that, but before that let's understand the concept of capital employed. What is capital employed? It is the amount invested by the owners in the company. Who are the owners of the company? Equity shareholders, preference shareholders. You already know this. But we can also say that debt holders are also the owners of the company, because of debt holders we have raised the capital of the company, that we have raised the cash from them and we have invested them in some part of the company, so it can generate returns for the company, right? So indirectly they are also the part of the company. So we can say capital employed is equals to equity plus debt. This is long term debt which is used for generating returns and interest is paid on the same. Okay, now if we understand, if we want to break this, we can do that. We can find capital employed in other way as well, that is non current assets minus current liabilities. Now it's not non current assets, it's total assets minus current liabilities. So we got another formula, that is total assets minus current liabilities. Now let's understand why we have this formula. So let's make a format of balance sheet. This is liability side and this is assets side. Okay. Now what we have understood, the first formula is equity plus long term debts is equal to capital employed in the company. Why? Because they both generate us assets. Now if we want to take an example, here we have our fixed assets, here we have cash, and then non-current liabilities, current liabilities. Now if we take an example that we raised a long-term debt, if this increases, our cash portion will increase, or if it's not cash, we will increase a fixed asset so that we can generate some amounts of we can generate a profit on that. Either we will have a cash for the first basis, then we'll purchase a fixed asset, or we'll purchase some sales. We will purchase some goods so that we can sell them and generate profits, right? So what here happening is, if we give effect in long term debts, it also gives effect in cash. If we reduce the portion of if we reduce the portion of cash, for example I'm reducing cash, let's say here I am putting A for asset, then I am increasing fixed asset. Either fixed asset is getting increased or my current liability will get decreased. How my current liability is getting decreased? Let us understand that concept first. See, if my cash is decreasing, there are chances that the I have paid some money to the current liability. Current liability can be OD or our creditors or the debts which have become current liability in the current year. So if my cash is getting reduced, either I have increased my fixed assets portion or I have decreased my current liabilities. So my whole point of making you understand this, that total assets minus current liability, is that whatever we do, the wherever we put impact in cash, it will give impact directly or indirectly in current liabilities part or fixed assets part. That's why either we add equity plus long term debt, or we do total assets minus current liability, our answer will be same. I hope you got the point what is capital employed and how we can calculate capital employed. Now next comes PBIT, that is profit before interest and tax.